Let me take you back to a time when I was just getting started with trading. It was one of those late nights, staring at the charts, trying to make sense of the chaos before me. I remember the frustration, the constant feeling of missing out on trades, and the overwhelming complexity of the market. But then, after understanding the hidden dynamics behind fair value gaps, order blocks, and rejection blocks, that changed everything. First, let's dive into fair value gaps, often abbreviated as FVGs. These gaps occur when there's a significant imbalance between buyers and sellers, causing the price to shoot up or down without fully filling the space between candles. Think of it as a skipped step in a staircase eventually. The market wants to come back and correct that skip. Now, why are these gaps so important? Well, they represent areas where the market is likely to revisit, offering us potential entry points. It's like a magnet pulling the price back to fill that gap, giving us a chance to capitalize on the market's inefficiencies. To spot a fair value gap, you need to look at the price action between 3 consecutive candles. If the wick of the first candle doesn't overlap with the wick of the third candle, you've got yourself a fair value gap. This gap indicates a strong momentum in one direction, often driven by institutional players who leave their footprints behind. Now, let's talk about how to trade these gaps. One strategy involves waiting for the price to retrace back to the gap after a strong move. Imagine you're a fisherman, patiently waiting for the fish to return to a known feeding spot. Similarly, you wait for the price to return to the gap, and then you enter the trade in the direction of the original move. For instance, in an uptrend, if you spot a fair value gap, you could wait for the price to retrace back into that gap before going long. This approach helps you enter the trade at a more favorable price, increasing your potential profit. On the flip side, in a downtrend, the same strategy applies. When the price retraces into a fair value gap, you can enter a short position, riding the wave of the market's momentum. Next up, we have order blocks, another crucial concept that can transform your trading approach. Think of order blocks as the footprints of smart money, those big institutional players who have the power to move the market. An order block is essentially a cluster of orders, typically found at the origin of a strong price move. These blocks represent areas of supply or demand where big players place their orders, and the market often revisits these zones to pick up more orders before continuing in the same direction. To identify an order block, look for a strong price move, either up or down, preceded by a consolidation or a series of small candles. The last candle before the breakout is your order block. This is where institutional orders were likely placed, and it's a key area of interest for us as traders. When it comes to trading order blocks, the strategy is similar to fair value gaps, but with a twist. You're looking for the price to return to the order block, where you can then enter a trade in the direction of the original breakout. This is like following in the footsteps of giants. If they found value in that area, chances are it's still a good spot to trade. Let's say you spot a bullish order block after a strong upward move. When the price retraces to this block, it's a signal to go long, expecting the price to continue higher. The logic here is simple. If big players bought at this level before, they might do so again. In a bearish scenario, you would look for the price to return to a bearish order block, where you can then enter a short position. This approach aligns you with the smart money play, increasing your chances of success. If you're finding value in these insights, don't forget to hit that like button and subscribe to our channel, Smart Trading Tactics. We're committed to helping you sharpen your trading skills with actionable strategies like these. And remember, by subscribing, you're joining a community of traders who are all working towards the same goal, trading smarter, not harder. Last but certainly not least, let's talk about rejection blocks. These are powerful reversal zones where the market has rejected a price level, leading to a strong move in the opposite direction. Rejection blocks are like the market saying, "Nope, we're not going higher or lower than this." They often mark significant turning points, making them invaluable for spotting potential reversals. To spot a rejection block, look for a candle with a long wick or shadow, indicating that the price was pushed in one direction but couldn't sustain it. The market essentially rejected that level, and the price moved in the opposite direction. These blocks are often found at the end of a trend or during a pullback, signaling a potential reversal. Trading rejection blocks involves entering a trade in the direction of the rejection. For example, if the market rejects a higher price level, you might look to go short, anticipating a reversal. It's like reading the market's mood. When it says no, you act accordingly. This strategy works well in overextended markets where the price is likely to pull back. On the other hand, if the price rejects a support level, forming a rejection block, you could enter a long trade, anticipating a bounce. This is particularly effective in markets that are oversold and ready for a reversal. If these strategies are helping you see the market in a new light, make sure to like this video and subscribe to Smart Trading Tactics. By doing so, you'll stay updated with more strategies and insights that can give you an edge in your trading journey. Plus, we'd love to hear your thoughts. Drop a comment below and let us know how you're applying these concepts in your own trading. Now that we've covered each concept individually, let's talk about how to combine them for even more powerful trading strategies. Imagine a scenario where you spot a fair value gap within an order block or a rejection block forming at a key level marked by an order block. These confluences can significantly increase the probability of a successful trade. Trading is all about stacking the odds in your favor, and by using these concepts together, you're doing just that. It's like assembling a puzzle. The more pieces that fit together, the clearer the picture becomes. Let's look at a practical example. Imagine you're analyzing a currency pair, and you spot an order block from a previous strong move. Within that order block, there's a fair value gap. As the price retraces to this zone, you also notice a rejection block forming, with the market rejecting a key level. This confluence of signals provides a high probability setup, giving you the confidence to enter the trade. In this scenario, you're not just relying on one concept, but combining multiple layers of analysis to make an informed decision. It's like building a house. You want a solid foundation, strong walls, and a secure roof. Each of these trading concepts contributes to that structure, making your trading approach more robust. Let's break down a trade using this combined approach. Suppose you're trading the EUR/USD pair, and you spot a bearish order block at a key resistance level. As the price retraces, you notice a fair value gap within this order block, indicating that the market may fill this gap before continuing downward. Just as the price enters the gap, a rejection block forms, signaling that the market is rejecting higher prices. This is your cue to enter a short trade. Your stop loss would be placed just above the rejection block, and your target could be set at the next significant support level. This trade setup has a higher probability of success because you're stacking multiple signals in your favor. In a bullish scenario, the same principles apply. You might spot a bullish order block with a fair value gap, and as the price retraces, a rejection block forms at a key support level. This alignment of signals provides a strong case for entering a long trade, increasing your confidence in the trade's outcome. Now, let me share a real-life experience where these concepts came together in a trade that I'll never forget. I have the screenshot that I kept after the trade played out. It was during a particularly volatile period in the market, with the GBP/USD pair showing erratic movements. I had been watching a key order block that had formed a few days earlier, anticipating a potential trade which was a reversal trade as the pullback ended. This was a good opportunity for me, as it was just the beginning of the trend. As the price approached this order block, I noticed a fair value gap within the zone, signaling that the market might fill this gap. Though there were some initial rejection in the gap, I still waited for a clear signal. I kept a close eye on the charts, and sure enough, a huge rejection block formed right at the gap, touching the order block and filling the remaining gap, rejecting lower prices. This confluence of signals was the green light I had been waiting for. I entered the trade, setting my stop loss just below the rejection block and targeting a significant resistant level above. The trade played out perfectly, with the market moving in my favor, filling the gap, and continuing upward. It was one of those moments where everything clicked, and it reinforced the power of combining these concepts in my trading strategy. The psychology behind these concepts. While understanding fair value gaps, order blocks, and rejection blocks is crucial, it's equally important to grasp the psychology behind these concepts. These patterns reflect the collective behavior of market participants, particularly the smart money, the institutional traders who have the power to move the market. When you trade these concepts, you're essentially aligning yourself with the intentions of these big players. For example, a fair value gap represents an area where the market moved too quickly, creating an imbalance. The market tends to revisit these gaps to correct the imbalance, giving you an opportunity to trade in the direction of the original move. Order blocks, on the other hand, are where the smart money has placed significant orders, creating areas of supply or demand. When the price returns to these blocks, it often signals the continuation of the trend, driven by the institutional orders that remain in the market. Rejection blocks reflect the market's rejection of certain price levels, often due to an imbalance in supply and demand. Recognizing these rejections can help you anticipate reversals and capitalize on them. Advanced tips for using these concepts. As you become more comfortable with these concepts, there are advanced techniques you can use to enhance your trading strategy. One such technique is using multiple time frames to confirm your trades. For instance, you might identify a fair value gap or order block on a higher time frame, such as the daily chart, and then drill down to a lower time frame, like the 1-hour chart, to fine-tune your entry. Another tip is to combine these concepts with other technical indicators, such as moving averages, Fibonacci retracements, or trend lines. These additional tools can provide further confirmation, increasing the probability of a successful trade. Risk management is also key. Even with high probability setups, it's essential to manage your risk by setting appropriate stop losses and position sizes. Remember, no trade is guaranteed, and protecting your capital should always be your top priority. As we wrap up, I hope this deep dive into fair value gaps, order blocks, and rejection blocks has given you a new perspective on how to approach the markets. Trading can be a challenging journey, but with the right tools and strategies, you can turn the odds in your favor. Remember, it's not just about knowing these concepts, it's about applying them consistently and with discipline. The markets are full of opportunities, but it's up to you to seize them. Keep learning, keep practicing, and most importantly, stay patient. Success in trading doesn't come overnight, but with perseverance, it's within your reach. Thanks for watching, and I'll see you in the next video. Until then, happy trading.